Hey folks, welcome you all to a new session. This is CA Ganesh Bharadwaj. So in this session, we are going to get started with a brand new chapter called as the cost of capital. Right? So shall we get started? Yes, fine. So now, first of all, our subject, financial management, has how many objectives? Guys, answer, come on. How many objectives? 3 objectives. What are they? Financing decisions, investment decisions, and dividend decisions. This is what we saw in the introductory session, and I told you that every chapter in our syllabus, right, goes on to achieve either of these 3 objectives. Correct? Now, what do you mean by financing decisions? Those decisions which are taken towards the fundraising activity. Yes, guys. And this chapter, cost of capital, squarely fits into the category of your financing decision. Are you clear with this? First that you need to know is which objective are we achieving in this chapter, right? Are you able to understand this, right? So this chapter relates to what? Fundraising activity. Clear with this, guys? Now, let me just give you a background example here. Now, let us say this is the balance sheet of the company, right? The company can raise money from different sources of finance, correct? When I say finance, capital, money, fund, these are all interchangeably usable words. Capital means, don't think it is equity capital. No, capital means money in normal financial language. Clear with this? Now, let us say company is raising. One source of finance is called as equity share capital. There is another source of finance called as preference share capital. There could be your debentures, there could be long-term loans, different sources of finance can be there. Correct? Now, each of these sources of finance, you tell me, guys, will it come free of cost? Will it come free of cost? Absolutely not. For every rupee the company is raising, they will be incurring some cost. Yes, the cost incurred towards equity share capital is called as cost of equity. Are you clear with this? And cost of equity is popularly known as KE, where K stands for cost, E stands for equity. Are you clear with this? How to compute and all that we will be seeing. Don't worry about that. I'm just introducing you to the terminologies used in this chapter. Now, similarly, preference share capital also, company needs to pay dividend and all these things, correct? Overall, preference shares also, this source also has some cost associated with it. The cost associated with your preference share capital is called as KP. Are you clear with this? Similarly, the cost that is incurred towards your debenture as a source of finance is called as KD. Are you clear with this, guy? Right? Now, one thing that you need to remember is in this chapter, whenever I use the word cost is always expressed as a percentage, not in absolute terms. Clear with this? Or one more point extra I'll tell you. This cost is nothing but the discount rate which we saw in our EVM chapter. Clear with this? Sir, how, sir? Simple. We saw an example where I told you IRR calculation. In that context, I told you one thing. Every complete financial transaction has both inflows and outflows associated with it. Correct? Let us say you are going to a bank, right? And you're opening an FD. From your perspective, what will you do? There will be first an outflow, followed by a series of inflow. And when we equate the inflows with the outflows, the rate that equates the two is called as a return we saw. Just flip the same financial transaction from the perspective of the bank. From the perspective of the bank, there would first be an inflow, followed by a series of outflow. Or, in short, can I say, IRR, when computed from your perspective, was a return for you. The same IRR, when it is computed from the perspective of the company, can I say it is a cost? Guys, correct? Yes, because it's the same transaction, only flipped. There was initial inflow followed by a series of outflow from the perspective of the company. Are you clear with this? That calculation is only called as your cost of capital expressed as a percentage, and for each and every source of finance, the cash flows will be different. For equity, there will be your equity dividend. Your preference, there will be preference dividend. For debentures, there will be interest. It can be different. So this calculation done for every source of finance is nothing but the discount rate or the IRR for that source of finance, which we are denoting it using KE, KP, KD, etc. Are you clear? Are you able to understand this? Now see how we have transitioned from our core mathematics, that is time value of money chapter, to our financial management using the TVM technique. Clear with this, guys? This is the reason why I said that chapter is like an oxygen. Without that, you can't even enter into the entire subject. Clear with this, guys? Now let us say, for example, the company raises 30 crore rupees from equity route, 20 crore rupees from preference share capital route, and let us say 50 crore rupees from the debt route, debenture route. Totally, the company has raised how much? A total of 100 crores. And let us say you did the IRR computation for equity share capital route, and you have arrived that the cost of equity is, let us say, example, how to compute and all we will see later, 12%. The cost of preference share capital, that is the IRR for this preference, is going to be 11%. And the IRR for debentures is going to be how much? Let us say 9%. So to put it short, can I say this 30 crore, every rupee raised in this 30 crore had a cost of effectively 12%. Correct? The cost of raising this 30 crore was 12%. Clear with this? The cost of raising this 20 crore was how much? 11%. The cost of raising this 50 crore was how much? 9%. Clear? Now they are saying, I don't want all this. Totally company has raised how much? 100 crore. Overall, you tell me, for this 100 crore, what is the net effective cost? Sir, 100 crore, there is no single cost. For 30 crores, cost is 12%. For 20 crores, cost is 11%. For 50 crores, cost is 9%. Overall, this 100 crores, what is the cost? That is called as KO, or popularly known as weighted average cost of capital. It's called as WACC. That is nothing but a weighted average of each different source of finance. How to compute, we will be seeing it later. Right now, I'm still at the introductory level. Are you clear with this? So there is no separate IRR calculation for WACC. It is nothing but source wise you would have done an IRR calculation, right? Weighted average and arrive at the final figure. As simple as that. So for this entire 100 crore, what is the average cost of capital? You average and you tell me, are you clear with this, right? This is the holistic picture of this entire chapter we are going to do. Sir, as simple as this, no sir. Why do we need this entire chapter? It's not like that. There are some technicalities involved in every single source of finance, and there are some detailed and advanced level computation that we will be seeing inside this chapter. And that is the reason why this chapter has a lot of numerical problems along with technicalities and all. One of the most important chapters. Every attempt, about 8 to 10 marks, gets tested in that 50-mark component of financial management. So ideally, the weightage of this chapter is around 16 to 20% of the FM component. 8 to 10 out of 50 means about 16 to 20% as a, if you're looking at it as a percentage. This chapter itself is a percentage chapter only, no? Cost is referred to as percentage, by the way. Guys, clear with this. Always remember, if you give a figure in absolute sense, it doesn't make sense. It should always be expressed as a percentage, only then it is comparable. Clear with this, right? So this is actually something I wanted to tell you all. And the most important thing that you need to have in your mind is, this chapter is, this entire calculations and computations in this chapter is done from the perspective of whom? Is done from the perspective of the company, not from the perspective of the investor. So this chapter is fully done from the perspective of the company. Have that in your mind. We are not computing this from the perspective of the investor. Are you clear with this? Are you clear with this? Right? Right? Now, basically, one thing that I told you earlier was that bank FD example. What is return from the perspective of the investor is, technically speaking, the cost from the perspective of the company. Correct? No. Your return is actually the company's cost, because what they pay is what you receive. Simple. Right? Of course, there are a few adjustments. There are a few exceptions to this rule. Right? What is what? We will be seeing it during the course of this chapter. But general thumb rule is what? Return from the perspective of the investor is cost from the perspective of the company. But there are a few exceptions to this rule. What are those exceptions? You will be understanding as we proceed into this particular chapter. Are you clear with the introduction? This introduction is a launching pad for you to enter into this particular chapter. Without this introduction, that perspective you will not be having and you don't know what you will be doing. That's the reason why I took this time and explained the perspective. Here with this, guys. Perfect. Now, look at this. Take your concept decoder book. Look at this. Cost of capital refers to the return expected by the providers of capital. This word expected is the most important word in this chapter because I will just give you a hint right now and leave it there. When we are doing the sums, I will walk you through this, the spirit behind this word. In financial management, we don't deal with the actual figures. Why? Because this subject is about decision making. This subject is not a post-mortem work. We are not in financial accounts where once the transaction happens, you record it. No, that's not what we do. If the transaction has already happened, where is the question of taking a decision for it? Clear with this? That's the reason why we use the word expected. Means what? We are dealing with the expectation of the providers of finance. So suppose if the company has actually incurred a cost, right? That actual cost is irrelevant. Today, if the investors are expecting something, we deal with these figures. It is based on the model of opportunity cost. Are you clear with this? So we don't deal with the actual figures. We generally deal with the expected figures. And that is the reason why they have used the word return expected by the providers of finance. And remember, return from the perspective of the investor is cost from the viewpoint of the company. Are you clear? This is a general rule subject to a few exceptions. Clear with this, guys? Right. Fine. So it's the return expected by the providers of finance to the business as a compensation for the contribution to the total capital, and it's expected as expressed as a percentage, right? And this is also known as the cutoff rate or the hurdle rate or the minimum rate of return, and it is used as a benchmark for taking capital budgeting decisions. What is the meaning of this? Capital budgeting decisions is basically your investment decisions. What is it? We will see in that chapter. Leave it right now. In short, this is nothing but the discount rate we studied in TVM chapter, right, which is used to discount or compound the cash flows or a stream of flow of cash, right? And in this chapter, the following terms will be used. The following terms will be used for discount rate. Instead of the word discount rate, we use the following terms for the respective source of finance. Equity, we call it as KE. For debt, it's called as KD. For preference, it's called as KP. Even retained earnings will come with a cost. It is called as KR, right? What it is, we will be seeing. Clear with this. And then overall cost of capital is called as WACC. WACC stands for what? Weighted average cost of capital. That is nothing but the weighted average of the previous 4 sources of finance. Clear with this? And it's referred to as KO. Are you all clear with this? This is nothing but a normal discount rate pertaining to every single source of finance. Are you able to understand the introduction? Done? Perfect. Now on this note, shall we get started, guys? Right. Now, before you enter into, right, the core of cost of capital, there are certain important terms or concepts that you need to understand. So every chapter before we start, I have this segment called as important terms or concepts used in this particular chapter, right? Similarly, we'll be doing for this chapter as well. Shall we get started, guys? Now, sorry. Now, number 1. Securities, any security, be it equity, preference, your debentures, any security can be issued either at par or at discount or at premium. You guys know this 11th standard accounts. Basically, any security can be issued at par, premium, discount. You know this. Suppose the face value is going to be 100 rupees. Correct? If they are issuing at 100 rupees to the public, it's called as par. Suppose they are charging less than 100 rupees for a 100 rupee worth of share, it is called as a discount. Example, 90 rupees, right? Suppose they are charging a premium, that is the issue price is more than the face value. In that case, you call it as what? A premium. You guys know this, no? Yes? Fine. Then next one. Similarly, even there are different types of redemption value. Even the redemption can happen either at a par or at a premium or at a discount. Agreed on this? Yes, agreed on this? Fine. In the absence of information, what we assume? We always assume that it is happening at par, right? Nothing is given. You can assume that both the issue price and the redemption value is at par. Correct? It's a very normal and a standard assumption. Yes, guys. Perfect. Now, here comes the one unique component that you need to know. Concept of flotation cost or issue cost. What do you mean by that? Now, is it visible? The screen visible? Right. Now, look at this. Flotation costs are those costs which are associated with the issue of new securities. Example, brokerage, underwriter commission, etc. Now, let us say the company is going to the primary market for issue or for raising of funds, IPO, right? Automatically they can go and raise money. No, they have some kind of restrictions. The first thing is, you would have studied in law. Ideally, you should have studied. There is something called as prospectus. The company needs to issue that prospectus, and they need to issue all these things. That a prospectus has a printing cost, right? Creation of prospectus also comes with some kind of cost, and not just that. Once you, once you circulate this prospectus, now these kind of these investors should actually come and they should invest at least 90% or something like that, right? It should be subscribed at least to the extent of 90%. All these things are there. Suppose if the company is not guaranteed of that, what they generally do, they actually hire these underwriters who will charge some underwriting commission and all. These are all some costs which are associated with a fresh issue of shares. Correct, guys? Yes, right? Now this is a cost. This is definitely a cost. Now in that case, what are we dealing with? I told you in this chapter, any cost from any source of finance is nothing but the IRR calculation. We are going to match the inflows with the outflows. Correct? No, right? Inflow from the viewpoint of the company, if you see, let us say every share is issued at 100 rupees. Example, I'm saying 100 rupees. So 100 rupees, the investor will pay to the company. Correct? But let us say the company has a flotation cost of 2 rupees for every equity shares issued. So technically, though the investor pays the company 100 rupees, technically they will receive how much? 100 minus 2, 98 rupees only. Guys, correct? So the net cash inflow at T0, that is today, will be what? Your issue price minus flotation cost. Are you clear with this? Because this entire subject of financial management is about matching your cash flows. Are you clear with this? Are you clear with this? So in this case, what happens from the viewpoint of the company, the first net issue price or the net proceeds the company will receive is going to be how much? Your issue price minus your flotation cost. Why do you minus your flotation cost? Basically an outflow from the viewpoint of the company. Are you able to understand this? Are you able to understand this? These cost applies only to new securities and not existing securities. In case it is given in the question, the issue price must be taken after deducting the flotation cost in order to arrive at the net proceeds, since it is an outflow and hence it is being reduced. Are you able to understand this? Right? Now let me add one more point to this. Now it will become interesting. Till now we saw what was a cost from the perspective of what was a return from the perspective of the investor was a cost from the viewpoint of the company. Why? Because the cash flows are the same. But if there is a flotation cost, there will be a change in this rule. Why? Because from your perspective, from an investor perspective, you would have paid a company how much? 100. Correct? So initial outflow was 100. Correct? From your perspective. But switch and look at it from the perspective of the company. When I am calculating, I am taking my net inflow as only 98 rupees and I do all my calculations. So my cost will be slightly different from your return. To understand. So I told you the general thumb rule is what? Your cost return from the viewpoint of the investor is equal to cost from the viewpoint of company, subject to some exceptions. I told you first exception is when there is a change in any cash flow, right? Because of the presence of something like flotation cost. In that case, my cost calculation will consider the flotation cost. Is the flotation cost borne by the investor? No. So from his viewpoint, he will not consider this, but from my viewpoint, I am considering it. Because of that, my cash flow equation will change. So I'm not using the same cash flows which you use, and hence there will be a slight deviation between your calculation and my calculation. Are you able to understand? But general thumb rule, if flotation cost is not that, then you are right. Your return is my cost. Are you able? Right. Now, generally in this area, there is one huge confusion which students ask me left, right, and center as a doubt. And this is one lacuna which actually in our institute study material also they have mentioned. This is a huge lacuna. That's why I have categorized this as a doubt buster area. So basically this area, many students have this doubt. So I have created that doubt here and I have clearly mentioned what is the solution that you can follow, the remedy for this doubt. Now in the question they are saying, let us say flotation cost is say 1% and they are leaving it there. This percentage can either be applied on the issue price or on the face value in the absence of information. Clear with this? Let us say, guys, the face value of every share is 100 rupees, right? And the issue price was, let us say, 110 rupees, right? The money that I'm receiving from the public is how much? 110, right? Now, let us say they have given that flotation cost is 1%. Will you apply this 1% on the face value, or should you apply this 1% on the issue price? This is one general doubt with which actually arises, right? Now, institute themselves are saying you can take an assumption whether to apply it on the face value or to apply it on the issue price. If in the question they have specifically given your flotation cost is 1% on face value, then you should only apply it on face value. Or they have given 1% on the issue price, then you should apply only on the issue price. Nothing is given. You can take any stand and you do it. But very strictly speaking, logically, I'm saying you, exam perspective, that's all over. Take anyone in the absence of information. But in my perspective, logically, it should be applied on the issue price. Reason, underwriter's commission, he will charge on the issue value, correct? He'll say, pay me 1% on the issue value. He for him, face value is of no use. He'll say, face value, you keep it as 10. If you are actually raising, for every share, you are charging 500 rupees, 400 rupees premium. Yes, practically it is possible, right? In that case, what will happen? So he charge on 100 rupees or 500 rupees. He will obviously charge on the issue price. He will say, look, I am dealing with a total value of so much, you pay me on that. Strictly and logically speaking, my stand is it should be on issue price, but in exam you can take any stand, but write a note and leave it there. Are you able to understand this? Right? On that note, this particular concept is also over. Clear, guys? Done. Shall we move on to the next one? The next most important part of this entire chapter is the concept of tax savings on interest. Shall we get started with this area? Yes. Now, what is this concept of tax saving? Now, payment of interest to debenture holders are allowed as expenses for the purpose of tax, right? And hence, they can save the tax liability of the company. And saving in tax liability in the, for the company is also known as tax shield. Now, what is this, sir? Now, guys, some basic of income tax. Forget income tax. Your profit computation when you have, right? Your income tax when you are paying, a company when it is paying, the income tax is paid on what? On your profit, correct? And for the purpose of this profit computation, there are some expenses which are allowed as a deduction. Your sales or your revenue minus expenses is only a profit. On this profit only you pay tax. And one of those allowed expenses is your interest paid on any debt instrument, interest on debentures or interest on loan. Is it allowed as a deduction for the purpose of income tax? Yes, absolutely it is allowed. In fact, it is covered in a section called section 36(1)(3) of your Income Tax Act. All those things are not required, but I'm just telling you that it is an allowable expense for the purpose of tax. What do you mean by this? Now, let me give you one illustration. Let me give you one example. Now, let us say there are two companies, company A and company B. Okay. Both the company has the same total capital employed in both the companies is, say, let us assume it is same. Let us say 1000 crores was invested in this business. Which business? Both company A and company B, right? But the only change was, let us say, example only I'm giving you, equity and debt. Company raised money only through two sources of finance. Okay, let me just put it here. Second. Let us say equity, debt, preference and total. Company A, what they did, they raised this 100,000 crores. They raised it. Out of this example only, I'm telling you guys, 700 crores they raised from equity route, 300 crores they raised from debt route, correct? How about company B? Company B, totally 1000 crores only. 700 crores they raised from equity and 300 crores they raised from preference route. Example I'm saying, right? Now, what happens in this case? Both the companies, total capital employed is what? Same, 1000 crores. Agreeing with me? Agreeing with me? Any problem here? Now, what happened? So, both the companies assume are in the similar risk class, right? So, they are normally operating. Everything is same. both the companies are starting with the same EBIT. EBIT means what? Earnings before interest and tax, or in other words, EBIT is nothing but your operating profit that you calculated under your costing subject. Correct? Earnings before interest and tax. In your costing, you have this marginal costing income statement and all. Sales minus variable cost gives you contribution, minus fixed cost gives you profit. You say no, that profit is only EBIT. Right? Once you arrive this EBIT, from then on FM starts. This is why I generally say FM starts from where costing stops. Are you clear? Are you clear with this? So basically these two are interrelated subjects. That is the reason why we are actually learning it like this. The next chapter, leverages, I'll deal more about the concepts of marginal costing, which is a background for that chapter. But coming back here, both the companies are starting with what? The same amount of EBIT, which is 100 crores. Clear with this, guys? Now what happened? Company A paid an interest of 30 crores. Let us say that is 10%. This debentures is carrying a cost of 10%. This preference shares is also carrying a cost of 10%. Both, that is also same in for both the companies. Correct? So now what happened? Less interest for company A, it is 30 crores. Company B, interest is not there. So it is nil. Clear with this? So your EBT will be how much? 70 and 100. Now tax at the rate of 30% on EBT is how much? For company A, it is going to be 70 into 30%, which is 21. For company B, it is 100 into 30%, it's going to be 30. So earnings after tax will be what? 49 and 70 respectively. Now less preference dividend. Now preference dividend will be reduced. Now for company A, there is no preference dividend. For company B, you have 30 rupees of preference dividend. So finally, the net earnings available to equity shareholders is going to be 49 rupees for company A and 40 rupees for company B. Right? So the format of your income statement will be EBIT minus interest, you call it as EBT, minus tax, you call it as EAT. Now is everything available to equity shareholders? No. First, you need to pay the preference dividend. So minus preference dividend. Now whatever you have is available for the equity shareholders. I popularly call this as EFE for all our classroom discussion. EFE stands for what? Earnings for equity shareholders. Clear with this? This is what? Your earnings after tax minus your preference dividend. Clear with this? What happened? Both the companies are similar in all types. They started with the same starting point. Number one. Number two, both the companies raised the same total amount. And for company A, the only difference was company A raised from debt route, company B raised from preference route. But that also, both the companies were having the same cost of 10%. Still, sir, how is company A earning more profit than company B? Company A is earning 49 rupees. Company B is earning only 40 rupees. Incrementally, company A has earned how much? 9 rupees more, or 9 crores more. Rupees in crores. Clear with this? How is this possible? This is because, if you notice, company A paid a tax of only 21 rupees, whereas company B paid a tax of 30 rupees. Now, actually seeing the difference in tax was company A ended up paying lesser tax to the extent of 9 rupees. Lesser the tax amount or lesser the cost, more will be the profit. Here with this. Sir, then why did company A pay lesser tax? Because the base for you to compute the tax is your earnings before tax. Agreeing with me? Now, for the purpose of computing the base to calculate tax, interest alone is allowed as a deduction. Why? Because preference dividend is not an expense, it is an appropriation of your profit. Because to some extent, even preference shareholders are called as shareholders. Correct? No. So which means anything that you pay to a shareholder is not an expense, it is only an appropriation of profit. Yes, though they are legally speaking, they don't have any voting powers and all that, but they are also treated as one shareholder only. So amount paid to them is not an expense. So this 30 rupees was allowed as a deduction, correct? Or to put it in other words, out of 100, only on 70 the tax amount was computed. Or in other words, can I say on this 30 rupees, no tax was paid? Guys, correct? So to put it short, here can I say this 9 rupees, whatever company has saved, is nothing but your interest amount into tax rate. Correct? Interest amount into tax rate. What is your interest amount? 30 rupees. What is your tax rate? 30 percentage, 30 rupees into 30 percentage, that gives you how much? Is 9. This is the tax saving. Correct, guys? Correct, guys? Yes, are you able to understand this? Yes, are you able to understand this? Or one more step can I go and say, effectively, what is my interest cost? I paid 30 to whom? To the debenture holders, but parallelly I saved 9 rupees because I paid 30 rupees to them. So effectively, can I say my net effective interest cost is going to be rupees 30 minus rupees 9, which is equal to rupees 21. Agreeing with me on this? Agreeing with me on this? Because I paid this 30 rupees, government allowed this tax benefit on the interest component. So I was able to save 9 rupees parallelly. So my net effective interest cost is how much? 21 rupees. Yes, agreeing with me on this? Guys, are you all able to follow? Because this 30 rupees is what I paid. This 9 rupees is what I saved. So net effective interest cost is going to be 21 rupees. Agreeing with me on this? I call this as the post-tax interest cost. The post-tax interest cost, this 9 rupees is called as the tax saving on interest, also called as tax shield on interest. We just saw that. Are you able to? Is this facility available on preference dividend? It's there only on interest, correct? So one more point can I just say, how did we compute this figure? How did we compute this figure? Can we say that this 30 rupees is nothing but interest amount, right? And this 9 rupees is nothing but minus of interest amount into tax rate, correct? This 9 rupees is what? Interest amount into tax rate. Just now we calculated, no? Interest amount into tax rate. Yes, yes. Now, can I just say, take this interest amount outside. Can I just say, this is nothing but interest amount, the whole into 1 minus tax rate. Correct, no? Correct, no? Or in other words, can I say, the effective interest cost for me is I into 1 minus T. Because 1, how much is T? 30 percentage. Correct? So technically speaking, if I pay them 100 rupees, example I'm saying, if I pay them 100 rupees, effectively speaking, 70 rupees I'm parallelly able to save. So net effect, only 70 percentage of whatever pays my effective cost. Correct? Because every rupee I pay, parallelly 0.3 rupees I'm able to save. Or every 100 rupees I pay, parallelly that's a saving of 30 rupees. Effective cost is only 70 rupees of whatever interest I pay. Are you able to understand this? A very, very, very critical understanding. Spend more time here. You will thank yourself for a lifetime, because throughout this is what we are going to see, right? This is one very, very important and a core fundamental understanding here. So when we are computing the cash flows for debenture route, so when you are framing the cash flow equation, every year you are going to pay interest, but parallelly you will be saving some tax. So the net effective cash flow every year will not be interest, it will be interest into 1 minus T. This is how your cash flow equation will be framed, because whenever I'm paying 100 rupees, parallelly I will be saving 30 rupees. Example, illustration I'm saying. So net effective cost will be 70. Or in other words, in the numerator every year when you are saying the company is paying interest, parallelly there is a tax saving. So the post-tax interest cost will be what? I into 1 minus T. This will be appearing in your cash flow equation, because at the end of the day, what are we calculating? We are matching the inflows with outflows, and we are calculating the IRR for every source of finance. So you should first know what should be the cash flow every year. And in case of interest is being paid, parallelly there is a tax saving. The post-tax interest cost is going to be interest into 1 minus T. Are you able to understand this? Yes, you're all able to understand. The relevant cash flow for debentures is going to be what? Interest into 1 minus tax rate. Are you able to understand this? Exactly what I've put here. It can be clearly seen from the above example that despite having the same EBIT, the net earnings for company A is more as compared to that of company B, since interest amount is tax deductible expense, whereas dividend is not allowed as a tax deduction. Are you able to understand this? Right? So the post-tax cost of interest is what? I into 1 minus T. Every year when I pay interest amount, whatever this is, interest amount is paid, parallelly there's a tax saving. So net off, if you see, only this 21 rupee will be considered as a cash outflow from the viewpoint of the company. Correct? Because only because I'm paying the interest, I'm able to save this 9 rupees. So net off, every year I will say I into 1 minus T is going to be my cash outflow. Clear with this? So I will not consider 30 rupees in my cash flow equation. I will consider 21 rupees in my cash flow equation. Are you able to understand? Core important fundamental concept. Done, guys. Done, right? Now, on this note, we can get started with this chapter properly, right? So now let's take the first source of finance. What is the first source of finance? Debentures, right? Debentures or any kind of debt instrument. Cost of debentures. This is what we are going to see right now. Shall we get started, guys? Shall we get started? So debentures as an instrument, you know, the nature of debentures is what? So generally, there is a contractual obligation. It is basically a type of loan, but bundled as a security, correct? It also has the characteristics like face value, your redemption value, and all of that. The only thing here is that you pay a fixed amount of interest, as we just saw, correct? And this interest is what? Tax deductible in nature. So there is a tax saving on that also. So based on the redemption or repayment of principal on maturity, debts or debentures can be classified into two: irredeemable debentures and redeemable debentures. Yeah, we saw in the time value of money concepts, right? We saw some numerical problems. Some debentures were irredeemable, some debentures were redeemable. We solved some sums, you know, based on some instruments and all. We saw for equity, preference, and debt. Now, debentures can be irredeemable in nature. Debentures can also be redeemable in nature. By the way, in India, can a company issue irredeemable debenture? Can a company issue irredeemable debenture? The answer is yes, it is allowed. You need to take some special permissions, but then it is allowed. Clear? So irredeemable debentures are also allowed. Now, sir, then the same next question. Sir, if you only told no, sir, so which means the investor will put his money and he will never get it back, only interest. So then how will it be possible? You have a parallel market even for debentures, that's called as a debt market. You can't find that in your equity market. There is a parallel debt market where you can, buyers and sellers meet. There is a secondary market for debt. It's called as debt market. In the debt market, the transactions can happen. That debt market is present in order to provide liquidity to debentures. Are you able to understand? But it is not as volatile as your cash market. Cash market is basically equity market. Right? In markets, we have multiple segments like cash segment, F&O, and other things. But all those things are not required. But right now, understand that this is also possible. Okay, so fine. Coming back here, that was a practical insight. That's about it. Now, in case of irredeemable debenture, first let us take no mugging up, guys. No mugging up. Now, bring in that concepts of time value of money, left, right, and center. That is what we are going to see in this chapter. Fine. Shall we get started? Now, in case of irredeemable debenture. Now, guys, now you tell me irredeemable debentures. Okay. Now, what happens in case of irredeemable debentures? So, the same equal amount of cash flow will be paid up to perpetuity. Correct? No? Correct? No? So, can I say the present value of the debenture? Correct? The present value. How will you calculate the present value of an infinite equal cash flow? What is the formula for that? Infinite equal cash flow. What is the formula for that? Annual cash flow. Very good. Divided by discount rate. Correct? Correct? Now, in this case, the present value of debenture, can I call it as net proceeds? Because that is the amount that I get today from the investors, adjusting for any flotation cost. So technically, from the viewpoint of the company, that is the amount it receives. Can I say this is equal to what is going to be the annual cash flow in case of debenture? Every year, the company needs to pay interest. But wait, parallelly, there is a tax saving. So the net annual cash flow is going to be I into 1 minus T. Correct, guys? Divided by discount rate. What is the discount rate? In case of debenture, the discount rate is called as KD. Correct? So can I say this is nothing but divided by KD? Guys, correct? Or cross multiply this. Can I say KD is equal to I into 1 minus T divided by net proceeds? That is the formula that they clear with this. Very logical. Very, very logical. It's a crime to mug it up. That's what I keep telling you. It's all logical here, loaded with concepts. Clear? Where KD stands for cost of debt after tax. How are you saying it after tax? Because we are adjusting for the tax shield here. Right? I is the annual interest payment here. It's not the rate of interest. It's the actual interest amount. Right? It is in rupees. Then NP stands for the net proceeds of debenture or the current market price. I will come to that. Right? And T stands for the tax rate. When to take the current market price, when to take the net proceeds, I have a separate in the doubt buster session. I've in that segment I've kept it. Don't worry about that. But as of now, you just understand. Net proceeds stands for what? Issue price adjusting for flotation cost. That is the same concept everywhere. Here with this net amount the company receives today. Are you able to understand this? Any problem here? Any problem here? No. Now on that note, shall we get started and shall we do one numerical problem here? right? But before that, guys, once again, so what is the formula for KD? KD is equal to, in case of irredeemable debenture, I into 1 minus T divided by net proceeds, correct? The logic for this is all the time value of money concepts I told you are simply, sir, I didn't know time value of money, sir. Is there another way I can remember? Very simple. Look at this from the viewpoint of the company. What I pay divided by what I receive. From the viewpoint of the company, what it pays, interest into 1 minus 6. So net of the cost is post-tax only, divided by what it receives, net proceeds. Simple logic. Clear with this, guys? As simple as that. Clear with this, right? Learn it conceptually. That's about it. Fine, guys. So on that note, shall we go and do the first question? Yes, please take your solved question bank. Let's do the first question here. It's on page number 5. Please take the first question. Shall we, guys? Yes. Now, the first question here. A Limited issued 30,000 15% debenture of rupees 100 each. The cost of the issue was 30,000. Cost of issue means what? It is going to be flotation cost. Cost of the issue was 30,000 rupees. Determine the cost of debenture capital if they were issued at scenario 1 par, scenario 2 premium, and scenario 3 a discount. Clear with this? Now, first, guys, now this is a clear-cut case of irredeemable debentures. How do you know? Because they have given debentures. Have they given the life or the period has been given? Guys, no. When the period is not given, you can definitely assume it to be irredeemable in nature. Clear with this? Now, what do we do here? What do we do here? So now, what is the formula? Simple. What I pay upon what I receive. I into 1 minus T divided by net proceeds. Guys, correct? Now, in case it has been issued at a par. Now, guys, one thing. Please, attention here. 1 second. Yes, 1 second here. Now, you can do the calculations of all the KD and all these things, calculations. It can be done on a per debenture wise or per share wise. Or you can do the calculation for the entire value also. You can take the total and you can do it, or per share wise or per debenture wise also the calculation will be, you can do it. The answer will be the same. Not a problem. Now, in this case, we are doing it on a total basis because flotation cost is not given on a per debenture level. It is given in total. Correct? So what we can do is, now in this case, you tell me what is the total annual interest payout by the company. They have issued 30,000 debentures. Correct? It is carrying a coupon rate of 15% and the face value of every debenture is 100. So can I say the total interest payout every year is going to be 30,000 debentures into 100 rupees. On that 15% is being paid. Every year the company is paying an interest of how much, guys? Every year the company is paying an interest of how much? 4,50,000. Correct? Now, suppose the company is issuing it at par. What happens to the net proceeds? How much will the company actually receive? 30,000 shares, or 30,000 debentures into 100 they will receive. Correct? 30,000 into 100, but minus you have a flotation cost of 30,000. So the net proceeds will be how much? 29,70,000. Guys, correct? Correct? So now, so you just apply the formula. Interest 4,50,000 into 1 minus tax rate. In this question, the tax rate is not given. Clear? So assume it to be 0. If that is not given, then it's 0. That's all. Right? So interest into 1 minus tax rate divided by net proceeds. So in this case, my cost is going to be how much? 15.15%. Are you clear with this? Are you able to understand this? Take your calculators out and do this. Quickly, I'll give you some 10 seconds time. Quickly do this. Quickly do this. Digest the facts. We'll move on to the next step. Done? Done? Now, guys, all the calculations are exactly the same, but in case the company issues the debentures at a premium of 10%, what will happen? Only the denominator, net proceeds, will be different. Correct? Every share is now issued at 110 rupees. So 30,000 into 110 minus 30,000, net proceeds will become 32,70,000. That alone you put it in the denominator. Everything else will be the same. So now the cost becomes what? 13.76% is going to be your KD. Are you able to understand this? Right? Suppose the company issues this at a discount. What happens in that case? Once again, here, the only difference is going to be what? The denominator calculation. So here, what is going to be your net proceeds? 30,000 into 90, right? Minus 30,000. So that's going to be 26,70,000. This alone will change. So the net cost is going to be how much? 16.85%. Are you clear with this? This is going to be your KD calculation. Are you able to understand this, guys? Any problem, any difficulties here? No? Right? And that's about the sum, and that's about this concept. Clear with this, guys? Right. Now you have your notebook, right? You have your notebook, right? Perfect. Now go to the last page of this notebook and give it a title. This is something that I only tell you one time, right? And after every sum, you need to do this. Give that page a title called Library of Adjustments. Library of Adjustments. Guys, quick. Don't waste time. Do it quickly. Okay. Now on the top have 4 columns: chapter number, question number, page number, small columns. Adjustment alone, you have a big column for the entire length of the page. Only one time I will tell you this. After every question, you need to give all the numbering. Adjustment alone, I will dictate. Okay, right? Now, what is this, sir? Every question we discuss in the class. For time value of money, I didn't do it. That's why I mentioned it on the top of question, because that is not a part of your syllabus actually. But I introduced a chapter in order for you to understand or give you a perfect launching pattern into the subject. That's all. Now, now, for example, what is this chapter? Cost of capital. As per our book, this is chapter number 2. Question number 1. It's on page number 5. Give me the solved workbook, solved question bank page number 5. Page number 5. Now, adjustment, I will dictate, write down. Cost of irredeemable debenture hyphen direct. Cost of irredeemable debenture hyphen direct. Guys, quick, very quick. Cost of irredeemable debenture hyphen direct. Now, what happens? You have written it. Every sum we actually do in the classroom, I will be asking you guys to update. These 3 columns you need to update. This alone I will dictate and I will move on. Now, by the time we finish the batch, once you have a look at it, please don't write this on top of the question, or please don't, in the book and all, you don't write this, right? Please don't write it in your book. It defeats the purpose. Don't write it in the book, or don't write it at the back of the book. No, have it in your separate notebook, that too in the last page. So I asked you guys to maintain one 400 pages long sized ruled notebook for you to go home and solve all the sums independently. Right? You guys are having it, no? Yes. Very good. So in that book, you take the last page and you do it. From the reverse, you come, it's okay. So from the back, you come, it's okay, not a problem. You need not leave any spaces. Last page you take and you come from the reverse, it's absolutely fine. Why am I doing this? Imagine the day before your exam. Let us say you want to just revise on one particular topic. Let us say KD related sums. You need not take the pain in referring and turning pages. Open this book, you will have a ready reference of everything. This adjustment is also there. Which sum you want? Oh, this sum, okay, this was the unique adjustment we saw. This alone, somehow I'm not confident. You open that page number, revise that sum, and you're done. So this way, the entire subject can be revised 3 to 4 times a day before your exam, provided you have worked on it during the course of watching the lectures. If you watch the lectures like watching a web series, rather I would say you don't watch it at all, right? I've seen people binge watching, like lying like this on popcorn. Also, you will ask, don't do all that. Be sincere. If you are not watching the lectures sincerely, then it's of no use. So why am I telling you this is all your effort. By the time once the batch gets over and you'll have a look at this, you yourself will see the power of whatever consistent efforts that you have put. It would have snowballed into such a huge amount of effort, wherein then you will realize we covered so many sums in the classroom. This is the power of dedication and consistency. Please gift yourself that. That's all I'm asking for, right? And if you write it on top of the question then and there, it will not work out, because tomorrow the objective of this is all the questions discussed in the classroom should be in one place. If you write it on the top, once again you need to turn pages. What is the point then? This, please do it properly. Clear with this, guys. Everything else I've given it. This alone I wanted you guys to do it. That's the reason why I'm taking the time right now and explaining what is what, right? And that's about the library of adjustment. Now henceforth I will only dictate the adjustment. I will ask you to update, right? And guys attending here, in case I miss out on a question, if I go to the next question without dictating it, please stop me and ask me to do it. Okay, fine guys. Shall we move on to the next question? Now, I'll just go to the next question, which is question number 1A, right? I am doing this question for a reason. Now look at this. 1A, as I told you, the color coding, this background of this color, the background color of this question is different. And I'm also giving it a unique numbering called 1A. Reason is, it is very similar to question number 1, except for one minor change, right? This minor change alone, tomorrow when you're revising, if you look at it, you were sorted for the sum. You need not go to the entire sum once again. What is that? I will tell you right now. 5 years ago, Sona Limited issued 12% irredeemable debentures at rupees 103. That is at a premium of 3 rupees. 100 plus 3, 103. 3 rupees premium to the par value of 100. Fine. The current market price of these debentures is rupees 94. If the company pays a corporate tax rate of 35%, calculate its current cost of debenture. Now guys, don't look at the solution. Don't look at the solution. Whenever I'm handling a particular sum, you read the question, your eye should not enter into the solution, because if it goes, you are actually killing that thinking power. You are killing your own thinking ability. Don't do that. It's okay to make a mistake here and rectify it, right? Then you take a red ink and you can write down something. But if you look at the solution, it means that it will immediately go off. That's all. It will not stay. That's the reason why I'm saying. Now, you tell me, the formula for KD is what? What I pay upon what I receive. That is I into 1 minus T divided by net proceeds. In this case, what is your I? Every year the company pays 12% on 100, 12 rupees. Correct? Into 1 minus T, 1 minus 0.35 divided by what is going to be the net proceeds in this case? Can you tell me? Quick guys, quick. What is going to be the net proceeds in this case? Now they have given this figure. The company issued, right, 5 years ago, the company Sona Limited issued the shares at how much? Debentures at how much? 103 rupees, right? This was the actual issue price. So many of you might think that it has to be 103. It is not 103. It is going to be 94. Now, why? Recall the very first line of this chapter in our concept decoder that I gave. Guys, all this is not there in the material, even which I have given. Please write it down somewhere. Very important understanding. 1 second. It's loading. What did I say? Cost of capital is a return expected by the providers of capital. Now, in this case, what happens here is, 5 years ago, the company issued this debenture, right? Now, we are not doing a post-mortem work of recording what was the cost that I already incurred, that everyone knows. Clear? The intention of this chapter is, today, if I'm going to the public with this issue, what will be my cost? Are you able to understand this? I repeat, today, if I'm going to the public for issuing this debenture, what will be my cost? And hence, in this case, past data is irrelevant. If I'm going today, how much will I receive? Only 94, because prevalent in the market, the current market price is only 94. Current market price for debenture, how, sir? Just now I told you there's a debt market available. Guys, are you able to follow this? A very important and a critical understanding that you need to have. Able to follow this? Yes, write it down somewhere. Write it down somewhere in a way in which you understand. But remember this, past data is irrelevant, and we are not in a subject to record the actual cost. We are in a subject that takes a decision which is futuristic in nature. So even though this is an existing debenture, a past debenture issued, the intention of calculating KD is to know what will be the cost of debenture in case I go to the market today for raising this money. Are you able to understand? Many students are actually struggling in this area because they don't know. The first thing they struggle in this chapter is from whose perspective you are computing. The second struggle is, having said that, sir, why the actual thing is not given? Because I always tell, if nothing is mentioned, first preference for net proceeds, you should always take the issue price. If issue price is not available, then you should take the current market price. But in this case, it was a past data. It is not a current issue price. It was a past issue price. The share was issued some years back. We are not here to record the actual cost. We are in a subject that takes a decision which is futuristic in nature. Are you able? This is a very, very critical understanding. This explanations and all is not there in the study material, institute study material also, but they have done it like this. The doubt here is why the background concept is what? This is the value addition that you get in the lectures. This is not there in the book. Clear with this? Write it down somewhere. Fine, guys. Done. That's about this particular question. Go update your library of adjustment. Give the reference 1A, page number and all. I'm just telling you this. Write down cost of irredeemable debenture hyphen use CMP as NP. Use CMP as NP. Use CMP as NP. CMP means what? Hello. Current market price. As NP. NP means what? Net proceeds. Put a semicolon. Semicolon is like this. Semicolon. And write down ignore old issue price. Ignore old issue price. Now just imagine the day before your exam, one look at this library of adjustment, you will know what was the discussion that happened in the class. You will be able to relive the classroom moment. Correct, guys? That is the reason why I'm asking you to prepare all this library of adjustment. Done? Move on to the next question. Move on to the next concept. Done? Yes? Perfect. Right. See, I have handpicked certain sums. Those sums I'm doing. If you are doing these lineup of questions, any other question you will be able to handle. That's how I have lined up the question for the fast track course. Right? Fine. Let's go on to the next one. So I told you debentures are of two types. One is your irredeemable debenture. The other one is called as redeemable debenture. Right? Okay. Now let's move on to the next one, which is called as redeemable debentures. Now, redeemable debenture means what? Debentures that have a finite life, which means what? I am issuing this debenture with a life of, let us say, 10 years, right? Which means what? Today I receive the money from you. You means what? An investor, right? For the next 10 years, I will be paying you interest. At the end of 10th year, I will also repay back whatever amount I took it from you. Correct, guys? But remember, the issue can be at par premium discount. Even the redemption can happen at par premium discount. Are you able to understand? But I will repay at the end of the period agreed. This is the meaning of redeemable debentures, which means it has a finite life. You can frame a cash flow equation here. Guys, correct? Now, for calculating the KD of redeemable debentures, there are two ways in which you can do. The first way is what? The correct way. IRR calculation. Frame the cash flow equation, arrive at the IRR and get your KD value. KD is nothing but the discount rate applicable for your debentures. That is called as your IRR. Nothing but that is your IRR. Clear? The second method is called as a shortcut method, also known as a formula method, also known as approximation method. One straightaway formula you apply. If you apply this formula, you will get the final answer. This is your KD, right? But that is not the exact KD. That is an approximate KD value. Are you able to understand? First, we will do the IRR method. It is popularly known as YTM method. YTM stands for yield to maturity. Write down somewhere, yield to maturity. YIELD, yield to maturity. Right? Yield to maturity. Always remember, guys, whenever they use the word yield, it stands for IRR. You need to use the method of IRR. There is one more yield to maturity model in equity KE calculation. So remember, yield stands for IRR generally. Clear with this? Now, how do we do this? I will take an example and I will show it to you. Now, guys, just focus. I just want your participation. That's all. All these notes will be given to you. Now, let us assume the period of debenture is going to be 10 years. Okay. Then the coupon rate. Coupon means what? Coupon rate means interest rate. This is not your IRR. It is an interest rate. This is not discount rate. It is an interest rate, 10%. Okay. And let us assume that the issue price, in this case, I'm also calling it as the net proceeds. Assume no flotation cost and all. Issue price is, let us say, rupees 900. Right? The face value of the debenture is going to be rupees 1000. And I am saying that this is redeemable at par. Redeemed at par. Okay. This is the scenario that I am giving. I am asking you to calculate KD. What will be the KD? Guys, clear with this? Please participate. That's all. It is more than sufficient. Right. Now, first thing, First thing, in this case, it is a case of debenture, right? And you have a finite life, means what? It is redeemable at par. Now, I need to calculate the rate of return. Basically, IRR, I need to compute. First thing, frame the cash flow equation. It is the most important thing. Frame the cash flow equation. We are doing this calculation from the viewpoint of company. So, can I say the present value of inflow should be equal to the sum total of the present value of outflows? Or in other words, can I say 900 should be equal to what is going to be every year's interest rate? Interest 10% on 1000. How much is it? 100. So can I say it is rupees 100 ideally into 1 minus t, but in this case I'm ignoring taxes for the convenience of calculation. Okay, right? But ideally if tax rate is given, that also needs to be computed. Okay, 100 divided by 1 plus kd to the power 1. Why am I using kd? R is nothing but kd. In this case, your discount rate is called as, discount rate for debentures is called as kd. Correct? Plus rupees 100 divided by 1 plus kd to the power 2 plus so on it goes, and in the last year you will be having what? 100 divided by 1 plus kd to the power 10 plus the entire repayment, the principal also gets repaid. So plus 1000 divided by 1 plus kd to the power 10. Are you able to understand? This is how my cash flow equation will look like. This is how my cash flow equation will look like. Guys, correct? Guys, correct? No. How do you compute the KD? Is there a formula to compute this? Do you have a formula to compute IRR? Do you have a formula to compute IRR? You don't have a formula to compute IRR. So what do? Trial and error. So one trial, take your KD to be equal to 10% or something, right? The trials will be given generally in the question. Calculate the NPV. Pray God that you should get equal to 0, right? Or in other words, can I say 0 is equal to, so the same thing, present value annuity factor of, okay, I'm just putting this as a single equation, rupees 100 into present value annuity factor of KD percentage for 10 years, correct? Plus rupees 1000 into present value interest factor of KD percentage for 10 years, the whole minus rupees 900. Agreeing on this. This is the cash flow equation. This is the sum total of outflows that I pay. Correct? That is from the perspective of the company. I'm netting off the two, inflow minus outflow I'm doing. So this sum total can be rewritten as follows. 100 rupees annually for the next 10 years. 100 into present value annuity factor for KD percentage. I need to calculate that for 10 years. That gives you this sum total. Plus 1000 happens only once. So 1000 into present value interest factor of KD percentage for 10 years, right? Minus 900 is equal to 1000. Or in other words, I need to calculate that KD percentage that makes my NPV equal to 0. That is called as IRR, no? Guys, yes. Are you able to understand this? Are you able to understand this? So how do you do it? Trial and error method. That's the only way to do it. Having gotten the two values of NPV, you use interpolation and find out the answer. Now quickly let me do it. Let KD is equal to 10% I'm taking, right? Now what you do, you apply this factor. I am just arriving at the NPV values. So I know that it is rupees 100 into, so present value annuity factor of 10% for 10 years, annuity table, you can actually calculate it in your calculator also. 1 divided by 1.1 is equal to, you put 1 m plus 2, 3, 4, 5, 6, 7, 8, 9, 10. You get 6.144. So is equal to m plus, is equal to m plus, is equal to m plus, like that 10 times if you do, and finally you do MRC, you will get the final value, present value annuity factor comes out to how much? 6.144. Are you getting it? Yes. Are you getting it? Yesterday I taught you the same thing, no? How to use m plus MRC in your calculator. Directly you can do, but don't worry, all these calculations will be given in the question, right? But I'm just teaching you how to do it once again, right? I'm revising that, that's all. Plus rupees 1000 into present value interest factor of 10% for 10 years. Again, 1 divided by 1.1 is equal to, like that. If you put 10 times, you'll get into 0.322, right? The whole minus 900. If you do the calculation, I think finally you will get a positive 100 rupees. This will be your NPV. Guys, clear with this. This is computation driven. Don't worry about it, right? You do the calculations if you want once again, but this is the final answer you will get. Now, can we say KD is equal to 10%? No. Why? Had KD been equal to 10%, had 10% been your IRR, that is KD, then you would have got a final answer of 0. But what is the answer you got? 100. So you want your final answer to reduce. How will you reduce it? By increasing your discount rate. This is what we saw in the trial and error method, right? So now what we do? Now take the next trial. Let KD be equal to 11%. Sir, how do I know 10 and 11? Generally, it will be given in the question. These tables will also be given in the question. 6.144, 0.322. But I am asking you to be self-reliant. Don't be dependent on anyone in life for that matter, right? So now, in that case, the KD calculation, in this case, I'm just cutting it short, guys. You get an NPV value of minus 13 here, right? At 11%, if you do the NPV calculation, right? So you will get the value of minus 13. Similar calculation, 100 into present value annuity factor of 11% for 10 years plus 1000 into your present value interest factor for 11% 10 years. If you do all this minus 900, final answer comes out to how much? It comes out to minus 13. Guys, clear with this? Are you able to understand? I'm teaching you the concept here. That's all. Clear with this, guys? Yes. Now, in this case, what happens? I know that KD is lying clearly between the IRR. Basically, the KD is clearly lying between 10% and 11%. Guys, correct? Yes, correct. Or in other words, can I say R and NPV? If I increase my R, I'm sorry guys, this was 12%. The second trial they took was 12%. This will be given in the question. If you are taking KD, the second trial that I took was 12%. Okay, not 11. I took 12%. If you take 12% as the second trial, you get a negative NPV of minus 13. Are you clear with this? Right? What happened? Okay. 100 into 6.144. I'm sorry. This is not 0.32. This is 0.385 actually. Sorry, this is 0.385. I'm sorry, I stand corrected. So, see, I was not focused more on the calculation here. I wanted to drive home the logic here. But yes, this is 0.385. If you do the calculation, you get a positive 100 here. Right? You're right. Fine. Coming back here. Right? So, see, this IRR, that's why I dealt with it in detail in the previous chapter itself. That is in your time value of money chapter itself. Right now, I'm focusing more on how to compute. Once again, we are just revising the concept of IRR in this KD model. That's all. Guys, clear with this? So now basically what has happened, if I keep my KD as 10%, I'm getting a positive 100. Guys, please focus here. Right? If I'm having a KD of 10%, the NPV value is a positive 100. If I keep my KD as 12%, I'm getting a negative 13. Or in other words, if I increase my KD by 2%, right, what happens here is my NPV falls from positive 100 to negative 13. It falls by 113. Correct? But I want my NPV to fall only by 100 to make it equal to 0. Correct? So for a fall of 100, by how much should my KE be increased from 10%? So it is the same calculation that we saw. So KD will be equal to 10% plus, right? If it is 2 for 113, how much is it going to be for my 100? So can I say it is nothing but 2% divided by 113 into 100. Correct, guys? Right? If it's going to be 2% for 113, how much is it going to be for 100? You do the calculation, tell me. 2 divided by 113 into 100, that gives you 1.7699 something. So basically here it is 10% plus 1.7699. You can just round it off here. It's overall it's going to be 11.76% approximate. Are you able to understand this? Normal IRR calculation is what we have done here. Okay, you guys are able to follow this. Don't worry, I'll be giving you all this running notes. You need not have to worry about it. Just focus on whatever I'm taking here. That's more than enough. Are you able to understand? Yes, guys. So in case of a redeemable debenture, what you can do is frame the cash flow equation, take 2 trials, arrive at the IRR. Whatever IRR you get is called as the KD, because we are using the cash flows pertaining to what? Pertaining to debentures. Are you able to understand? Right? That's what they have given here. It is done by calculating your IRR. What is that IRR concept is what I have explained here. But remember, every year cash flow, what you need to consider? I into 1 minus T. Here with this. because it's not just interest, it is interest adjusted for tax rate, because that's my net cash outflow. Are you able to understand this? Right? And then I've just given you this. Clear, guys? Clear? Now there is a second formula. It's called as the shortcut method or a formula method, popularly known as approximation method. What does this formula say? What does this formula say? It says KD is equal to I into 1 minus T plus RV minus NP by N, the whole by RV plus NP by 2. Right? Easy formula. Huh? So you can mug it up. I will shift to the next one. That's all. Okay. Guys, very simple and logical once again. Very simple and logical once again. So how is it? Please focus here, boss. Please focus here. Now, KD is equal to, as per this formula method. This formula method, first one, let me tell you one thing. It ignores the concept of time value of money. It ignores. Then, so why are we calculating? For convenience sake. For convenience sake. Suppose in the question they have asked you to calculate KD and given all the facts. IRR calculation takes a lot of time. Nothing is mentioned. You can use even shortcut method and close it off. So shortcut method, sir, I need to mug up this formula. No mugging up. Very logical. I will tell you what is what. Now, what has happened? What has happened here? I just told you KD calculation, cost calculation is what? Numerator from the viewpoint of the company, what I pay. Denominator computation, what I receive. Correct? No? Logically, you think. Now, let us say we are talking about a debenture which has a life of 10 years. Okay, right? It is issued at 10%. Okay, the face value is 100. That is what? Issue price is 100. Redemption value is going to be 110, redeemed at a premium. Okay, done. Now, every year the company pays an interest of how much? 10 rupees, 10% on 100, 10 rupees. Correct? Just focus, that's all, enough. Right? So, in the numerator, obviously, this interest amount will come, 10 rupees. But wait, there is apparently a tax saving. Let's say tax rate is 30%. 10 into 1 minus T. Technically speaking, 70% of 10 rupees is only your cost, because parallelly when I pay 10 rupees, there is a 3 rupees of tax saving. So, this component you understood, it is the net interest cash outflow from the viewpoint of the company. Is correct? This is one cost. So, hence it lies in the numerator. Agreeing with me on this. Next. Now, is that the only cost the company is incurring because of this? No. When I received money from this guy, from the investor, from the debenture holder, I received only how much? 100. Issue price was 100. But when I am redeeming it at how much? 110 rupees. Which means this extra 10 rupees is also my cost because I raised the money from the debenture channel. So, RV minus NP. RV is what? RV is going to be 110. NP is what? It's going to be 100. Right? This extra cost of 10 rupees is also my cost. Yes. But wait, that cost is not a cost incurred every year. It is a cost incurred during the life of this entire debenture. So, divided by the life of the debenture, 10. If you amortize it net annually, I can say that representatively 1 rupee is the amortized cost of this difference between my redemption value and my net proceeds. Here with this. Hence, the numerator has the total annual cost that I am incurring towards my debentures. Logical, guys. Denominator is what? Your debenture capital. One more confusion. Sir, which one I need to take, sir? Because opening capital, that is my issue value, or should I take my end redemption value? No confusion. Take a simple average of the two. Yes? Yes? Now, tell me the formula for KD. Logically think, guys. That's all it takes. I into 1 minus T plus RV minus NP, but that's the total cost across the life divided by N, whole divided by RV plus NP by 2. Now you only said the formula, right? That's all it is. That's all it is. Are you able to understand? Yes, sir. Are you able to understand? Done? Now, one more incremental. This is the formula we'll be using regularly, guys. One more incremental thing. Now there is one argument. Some people say, look, this RV minus NP is there, no? 10 rupees amortized cost that you are saying divided by 10 and all. So representatively every year you are saying 1 rupee. That is also a cost, no? Then that should also be eligible for a tax deduction. If that is also a cost for you, that should also be eligible for your tax benefit, no? If you are assuming that is also a part of your tax benefit, then you put this one, into 1 minus t. This tax shield should also be applied on this. Or in other words, you take this 1 minus t common outside, and this formula will relook as follows. I, just the interest, plus RV minus NP by N. Everything is the same. But if you are assuming this tax benefit is applicable on both your interest as well as on this amortized component of the difference between your RV and NP, then take this 1 minus t common outside and say it is applicable on both. Are you able to understand this? That's what I'm saying. Yes. If you feel, if they are saying in the question, there is not a single question like this, but this formula is there in your study material, hence I've included. But this is only for theoretical purpose. In case we don't know, institute, we don't know, suddenly they might ask, and if they ask, if they are saying that, if both the interest payment is anyways a tax deductible expense, even this is also an expense only, from the viewpoint of the company, right? There is a section in your, section in your income tax act that says discount on issue or premium on redemption, that is also a cost. It is allowed over a period of so many years and all. It is there in your section. So if ideally that is also a cost, on that also tax shield needs to be computed. So not only on this should you apply 1 minus t, even on this value you apply 1 minus t. So that's why they have taken it common and they have put it. Clear with this, guys? But for that, nothing more you need. Clear with this? Should you mug this up? Should you mug this up? So simple, no? So simple. If you directly enter into it and if you just break your head, it will only break. Are you clear with this, guys? It's so easy. Fine. One last time, can you just tell me the formula? What is the formula here? First formula only. Second formula, you just ignore it. Right? First formula. What is the formula here? So KD is equal to I into 1 minus T plus RV minus NP divided by N, the whole divided by simple average RV plus NP by N. Here with this. Here with this. Now we do sums with respect to this particular thing. Right? One sum, you will just do it here. Take the next question. To work. Call the question back. See how simple it is, provided you understand it in a graded manner. That's all it takes, guys. Always believe in conceptual learning. If you mug up, it will not work out. And that too, institute is asking questions like anything. And trust me, I'm the first person to love the way institute is being, they are testing, because, sincerely, you guys are studying the concepts. Someone is mugging up and going and they are also getting the same thing. Actually, that's not a CA exam then, right? You should know. Tomorrow you're sitting for an interview, right? And if someone is asking you the logic of why you are calculating KD, why KD has this formula, now you will be able to tell them, right? Right? And one more thing, guys, one more thing I want to tell you. One more thing that I want to tell you. Is this formula method correct? Is this the correct approach? Is the formula method I told you, whatever I taught you, is this correct? As in, it is not the very right approach. The correct way of calculating KD is only your IRR, yield to maturity method. But we are doing this for convenience sake. I will prove to you why. Because you tell me this formula is actually not at all correct. Reason is RV, redemption value. When does it happen? At the end of 10th year. NP, net proceeds. When do you get it? Today. Now, can you directly subtract a cash flow arising at the end of the life with a cash flow arising today? Put it short, this logic defies the concept of time value of money. That's why it's called as approximation. It's not an exact value. That's the reason. Okay, now let's go and do the sum, guys. Quickly. Now it's going to be very simple. It's a cakewalk for you. A company issues, question number 2, guys. A company issues 10 lakh rupees worth of 12% debenture of rupees 100 each, right? Which means how many debentures have been issued? 10 lakh divided by 100. 10 lakh divided by 100 is going to be 10,000 debentures. Right? The debentures are redeemable after the expiry of a fixed period of 7 years, and the company is in a 35% tax bracket. Required number 1, calculate the cost of debt after tax. Always remember, when they use the word KD, it is post-tax only. Why? Because tax shield is considered in calculation, no? Interest, I into 1 minus T, only we calculate. If the debentures are issued at A, par, B, 10% discount, and C, 10% premium. Right? And the second part of the question says, if a brokerage of 2% is paid, what will be the cost of debentures if the issue is made at par? Now, forget the second part. Let's focus on the first part. Guys, hello, come on. Now, you leave the calculation to me. Just participate here. One last time, tell me the formula for calculating KD. Formula approach. In this question, have they asked you for an approach? Use IRR or YTM model. Did they say? No, which means what will you use? In exam, happily use your formula. Don't say, no sir, it is approximation. I will only want the get correct answer or not. Then you will have to wait for 4 more months. So don't do all that. In exam, you need to properly sit and make the best use of it. Play it smart in the exam. Do it only in formula method if nothing is asked. Clear? So what is the formula? Come on, tell me. I into 1 minus t plus RV minus NP by N, the whole divided by RV plus NP by 2, right? Clear with this? NP stands for net proceeds. Net proceeds means what? Issue price adjusted for flotation cost. From the viewpoint of company, we are calculating net amount what I get today. Are you clear with this? Right. So now the same formula is what is mentioned here. Now, what have they given? I'm listing out, guys, just follow whatever I'm saying. That's more than enough, right? In this case, what they are saying, redemption value is how much? Nothing is mentioned, huh? Or have they mentioned it's redeemed at par? Nothing is mentioned. You assume it to be at par. Clear? Redemption happens at par. What is the net proceeds? They have given the first part of the question is at par. So it's going to be 100, right? Tax rate is 35%. So interest rate is going to be 12%. So in the first year, so I mean for the first part of the question, so what is going to be the KD? 12 into 1 minus tax rate, the whole into redemption value 100 and net proceeds 100. Now, is there any cost? Is there a difference between my RV and NP? No. In that case, there is no cost associated with this. That's all. Clear with this? The only cost is interest cost. Clear with this? The whole divided by RV plus NP by 2. Are you clear with this, guys? Right? Getting it? Getting it? Fine. So technically what you get is 7.8 upon 100. This is going to be 7.8%. Guys, are you clear with this? Or in other words, can I come to a conclusion? This is just one observation. When you are issuing at par and also redeeming it at par, can I directly say for KD, the only cost is interest cost? Correct? There is no difference between the two, no? Are you understanding this? When I'm issuing and redeeming it at par, the only cost associated is what? Interest cost, right? Directly can I say KD is going to be your interest rate into 1 minus t, right? In this case, 12 into 0.7, what is this? Tax rate is 35%. 12 into 0.65, how much is it coming out to? 7.8%. That is what we got now. It is a small observation, right? Just, extra knowledge I'm giving you. As simple as that. Clear with this, guys? Now, suppose in the same question, they are issuing it at 10% discount. What happens? Very simple. All the calculations are same. The only difference is what? Net proceeds will be 100 minus 10% on 100. That is going to be 100 minus 10, which is 90. And just to substitute that alone in your calculation. Now, guys, what happens here? It is being redeemed at par. 100 rupees, but issued at a discount. Correct? No. It was redeemed at par. That is, today I'm getting money of 90 rupees issued at discount. Correct? No. I'm getting 90 today, but I'm repaying 100. Similarly, the 10 rupees of extra cost is also there here. Correct? No. Are you able to understand this? That gets captured here, and overall your KD is going to be 9.715%. Are you understanding this? Are you able to understand this? Yes? What happened? Yes? Right? The next one. Okay, so here we have done it on a per debenture level. If you want, you multiply. What will happen in that case? So how many debentures were issued? You multiply the 10,000 in the numerator. You will once again multiply the same 10,000 in the denominator. It gets anyways knocked off, right? If you want, you can do it on a whole level also. That's why I said per debenture wise or total wise, answer is going to be the same. No problem. Clear? Fine. Next, interesting part. Suppose the debentures are issued at a premium. Now what happens, guys? I am redeeming it at par only. When I redeem, I will redeem it at 100. When I received money from the public, how much I got? 110 rupees. Now, if you look at this calculation, I into 1 minus t, this is my cost. Correct? One cost. Interest cost is there. Post-tax. RV minus NP. That is, what happens? I am receiving 110, but I am repaying how much? Only 100. Here, actually I am gaining. Are you able to understand? Are you able to understand? See, I am getting 110 today, but when I am repaying, I will repay only 100. Which means Here overall, there is actually something the money earns out of this that goes on to reduce your interest cost. So here the net amount will be minus. Are you able to understand this? Are you able to understand this? So net effectively what will happen? Your overall cost will reduce to 6.067%. Are you able to understand this? Don't think here minus is some typo error. It is actually correct only. No, I received 100, but I'm repaying. Sorry, I received 110, but I'm repaying only 100. In this case, the company stands to gain. So whatever the net gain is there, that goes on to overall reduce my interest cost also. The final post-tax cost of debt is actually very, very less. It's only 6.06. Are you able to understand this, guy? Are you able to understand? See how interesting this is. A very, very interesting point. Done? Yes. Yes. Shall we move on to the next one? Yes. Now, the next part of the question says, assume that the company is paying a brokerage of 2%. Okay. And what will be the cost of debentures if the issue is at par? If the issue is at par. Now, let's say we are recomputing, assuming the issue is at par, right? But the only difference is what? You have given a flotation cost, brokerage, which means for net proceeds, what will you do? Issue price of 100 minus flotation cost of 2%. Are you clear with this? Nothing is mentioned in the question. This 2% can be applied either as a percentage on your issue price or on as a percentage of your face value. I told you, no, flotation cost, you have two options. In this case, there is no problem because the issue itself is at face value only. So both will be the same. But remember, if nothing is mentioned, write a note saying any logical assumption you take and you can do it. Strictly speaking, it should be a percentage on issue price only. But I told you for examination purpose, institute is allowing both. Randomly in one question, they are taking it as a percentage of issue price. Randomly in the next question, they are taking it as a percentage of your face value. Any logic, no logic is there for that, but they are just taking it like that. Clear with this? Now, the computation, guys, what happens here? Brokerage is 2%. So the issue price is 100. Minus brokerage cost is 2% on that 100. It's going to be what? 100 minus 2, 98. Now what you do here is, for all your computation purpose, you take this 98 as your net proceeds. So I into 1 minus T, correct? Plus RV 100 minus NP is 98 divided by 7, the whole by RV plus NP by 2. You get an effective cost of 8.168. Are you able to follow this? Are you able to follow this? Every single step I'm walking you through, as simple as that. Clear with this, guys? Done? Just go and update your library for adjustments. Write down. Write down. Quick. Question number 2, give all the page number referencing and write down. Cost of redeemable debenture. Cost of redeemable debenture within bracket, formula method. Within bracket, formula method hyphen. Within bracket, formula method hyphen. Par stroke premium stroke discount. Par stroke premium stroke discount. Par stroke premium stroke discount. Are we done here? Are we done here? No. Now let's go to some common doubts that students have in this area. One second, I'm just erasing all these things. Okay, now the common doubts that students have in this area. Now, suppose they have given the question, calculate KD. Sir, should I use IRR method or should I use formula method? You can take any method in the absence of information. Preferably use a formula method to save time. Clear? That is about the first doubt buster. Next. The approximation method gives only approximate value of KD, whereas YTM method gives the accurate value of KD. Clear with this? Next. Under the approximation method, even in approximation method, in the absence of any specific information, students may use any of the two formulas to calculate KD with logical assumption. What was the two formula? One formula we assumed that only interest is a tax deductible expense. The second formula we said even the spread between my RV and NP, right? That is also tax deductible. We took that outside. Generally, we don't use the second formula. It is generally not used in any of the questions. We only use the first formula. Are you clear with this? Right? Whatever, in all the sums that we did, we only use this formula. No? Did we assume that the difference between the two is also tax deductible? Did we assume that? No, we didn't assume that. We assumed only this is tax deductible. Are you following this, guys? Yes. The next one. Now, net proceeds stands for issue price less flotation cost. What the company actually receives. Net cash inflow. Suppose in the question issue price is not given. For the purpose of computing net proceeds, first the preference should be given to issue price. If the issue price is given in the question, take it. Not past issue price. Current, if they have given issue price, that you take. We saw in one question of past issue price, that is irrelevant. Past data is irrelevant for our subject. Clear with this? Suppose issue price is not given, but they have given in the question the current market price is so and so. You can take the current market price, that takes the second priority. Why? Current market price means what? Today if I go to the market, that will be the rate prevalent in the market. So suppose even if the company wants to make a fresh issue, it can only be around that price, no? Are you clear with this? That's why. Suppose current market price is also not available, then you assume that the issue was made at the face value. Are you under? A very logical and a graded assumption. Preference number 1, issue price. Preference number 2, current market price. And preference number 3 goes on to face value. These assumptions are applicable for even your equity and preference. Clear with this? That is the reason I'm spending a lot of time here, right? So if the issue price is not given, then students can assume it as equal to CMP, current market price. If that is also not given, only then you can take it as equal to face value. Suppose the flotation cost is not given, simply assume it to be 0. If tax rate is not given, take it as 0. Don't break your head with all the assumptions. Here with this. Are we done here? Are we done here? Perfect. With that, we have completed this concept of cost of debentures KD. There are some other issues which I will be dealing at the relevant point of time. It's not required at the moment. Clear with this? There is a way in which I take the subject, so I will go there, but I will do it in that way. But when you are revising, so all the KD related concepts, I've clubbed it in a single place. So you can go in this order itself. That is not a problem. But right now, for a logical flow of understanding, I will just move on to the next concept. So with this, KD is done. Done. KP is also over. KP is also over. KP is cost of preference. Exactly the same as KD, except for the fact that in KD, the cash flows will be I into 1 minus T. Here all the cash flows will just be preference dividend without adjusting taxes. That's all. The entire KP is also over. I will walk you through that. We will also do some here. Clear with this, guys? This is why I spent a lot of time in teaching you the KD concepts. KP is automatically taken care of. Done. Done. A very, very smart approach in which you can learn the subject. Done, guys. Now we will discuss KP. Don't worry, I will not directly omit. Even these areas I will not omitting. I will come back. Okay. By the way, this first topic is already done. Amortization of debenture or bond. Last question of time value of money chapter, we did know every year over the span of 8 years, it gets repaid. In that case, how will you arrive at the present value of the bond? You need to prepare that cash flow statement every year, 125 rupees. You remember 1000 divided by 8 and all we did. That is what they have mentioned in the study material by way of formula. We did one sum at the time value of money level itself. So ideally, this is also over, right? I just gave it as one. See, till now, whatever we've seen here, it is a single shot payment. Issue and redemption happens only at the end of the life, correct? Whereas there can also be cases where the debentures can be amortized over the life and all, right? If that scenario happens, right, what should you do? Here I've just given a reference. Maybe you can write down here. Just pull an arrow and write down. Refer TVM chapter, question number 9, I think so. Last question, huh? You write it in your book. Please write it in your book, right? Refer this TVM chapter, question number 9. You can just write it there, okay? For a practical illustration on. The interest will be computed only on the opening balance. WDV method and all we did know. Guys, amortization table. Yes. Yes. Fine, guys. Done. Shall we move on to the next one? Shall we move on to the next one? Perfect. Let's go on to the next one. It's called as preference. Done. Now, preference shares. This is another source of finance for the company. Agree? So a company can choose to raise money even from the debenture, the preference route. Now, preference shares, I call this as an hybrid animal. It is an hybrid animal. Why? It takes one character from equity. It takes one character from debt. It is like cat on the wall. It doesn't have any decision. It doesn't have a separate, nature by itself. It takes one nature from one guy, another nature from another guy, and it calls itself one zombie. That's all, right? Basically, what is that nature, sir? Preference share capital, it takes the nature of a fixed dividend payout. You need to pay a fixed dividend. It needs to be paid generally, correct? Right? That way it is similar to your debt, correct? But it is not just that. It has some features like participating, preference shares. Suppose in certain case, preference shares can also come with some limited voting rights or something like that. There are some features bundled along with it. To that extent, it is similar to equity. That is the reason why the amount that is getting paid to the equity preference shareholders are called as dividend and not interest. And on top of it, what happens here is this amount is also not tax deductible. It is not tax deductible, no. Strictly speaking, preference shareholders are also outsiders. For namesake, you call them as shareholders, right? Always, general thumb rule, generally, these fixed preference shareholders are also having some equal, they also get some same, fixed amount of dividend gets paid. Even debentures also get paid fixed amount. So why should we have this instrument called as preference? Doubt is there or not? Always remember, the cheapest source of finance is only debt. KD is always the cheapest source of finance. KD will always be lesser than KP and KE also, right? Then why do we have this? Tell you, some companies, when a company is going for bank loans or when they are going for projections, when they are even approaching public and all, there are some parameters like debt equity ratio, right? For those parameters, this preference gets classified under the equity component. So some money, somehow if the company wants to maintain those parameters, for that purpose, they don't mind paying this extra money, but they just want this amount to be parked under the preference route. That's the reason why it is one residuary source of finance which generally companies fit into. That's all it is. Ideally speaking, it's not required. This is actually the core of finance. This is the reason why the top CFOs, the top bosses, they do a trade-off between, I am incurring some extra cost, but that's okay. Only if I do this, I know all my parameters are getting fitted. I can go for a bank loan, or I can raise money from public, or some investors will be attracted towards my company. For that purpose, they use it. This is a logical and a practical application of corporate finance in your real life. Maybe if you're sitting for an interview tomorrow and someone asks you this, you can give them, they will be shocked if you know all these things, right? Fine. That is the reason. Else, what is the purpose? Always the cost is more, no tax deduction. Why should I go for preference? I will go for debt itself, no? Clear with this. One more reason is that anti-dilutive effect. These guys don't have a control in the company. So if I issue this amount as equity, you can say, sir, you are not issuing it as debt because the company wants to maintain debt equity ratio. Then issue it as equity, no? If I issue it as equity, then they will sit in all the decisions of the company. I don't want them. I want them to remain as outsiders and still fulfill all my parameters of debt equity ratio and all those other things. Hence, I call them as preference shareholders for namesake, and I keep it. Are you clear? So if I am assessing one company, in my opinion, based on what decision I want, I will classify preference only as debt component. If I am looking at a debt equity ratio, that's what I will personally do, I'm saying, right? Or depending on the nature of decision that I want to draw on the company, I will categorize it either as equity or as debt as per my choice. I am telling you personally, when I do all these kind of analysis, that's how I do it. Depending on the objective you want to achieve, I will give the result accordingly. That's how I do it. But for all your examination purposes, right, this is how things are, and I'm just explaining you why preference as a source of finance is there. Clear with this? All these are actually only for namesake. This is actually kept as a saving clause for many top bosses, top finance bosses of companies, right? They do all these things only for the purpose of fulfilling or attracting the external investors. I have personally prepared prospectus for companies like projections and all that. Nothing will be there in the company, right? That's all it is there. So now no figures are there, but basically I've sat in the groups where they actually prepare this prospectus and all. But it is all based on the potential. That's how you actually evaluate a company, not purely based on the past data. So they give all these things, and they also mention this. In that case, the banks and all will look for this debt equity ratio and other analytics. For that purpose, as a saving clause, they keep. But anyways, guys, coming back here. So this is all it is. So are you all able to understand that this concept of preference is basically a hybrid annual? It takes one character from equity and one character from debt, right? They pay dividend at a specified rate, and the payment of dividend are not charged as an expense, but they are appropriation of profit after tax. We saw all those explanation before, right? And hence dividend paid to preference shareholder does not reduce the tax liability. Now, exactly like how debentures are, even preference can be of two types: irredeemable and redeemable. Correct? No? Right? Redeemable preferences, irredeemable preferences. Now, in case of irredeemable preference, what will be the formula? Now you tell me, from the viewpoint of the company, every year the company is paying what? Preference dividend. Correct? Right? So now basically the same formula, what I pay divided by what I receive. Correct? What do I pay them? Preference dividend. Into 1 minus t will come? No. Why? Because this is not a tax deductible expense. The entire amount I pay these guys is actually my cost. Correct? Divided by what I receive. This P0 is nothing but the value of the preference shares today, or you can also call it as net proceeds. You can use the word NP or you can use it as P0, not a problem at all. Are you clear with this? Even similarly, the net proceeds of your debentures, it is popularly called as B0. People call it as B0. B0 means what? The value of bond and debentures are ideally the same. So this net proceeds, whatever is there, for bonds or debentures, they call it as B0. Some people call it as B0. B0 means what? Value of bond as at year 0, as at present. Are you able to understand this? Right? B0, P0 and all, these are some terminologies that are associated with the net proceeds of the respective instruments. Are you able to understand this? Right? So that's about this area. So the formula application, are you getting it, guys? So irredeemable preference shares. So the formula is going to be what? Preference dividend, what I pay upon what I receive. Preference dividend divided by net proceeds. Annual preference dividend, this is in rupees, right? Divided by net profits, this is also in rupees. Rupees in the numerator, rupees in the denominator. So it is expressed as a percentage. You can also write into 100 if you want. Clear with this, guys? Done? Done? Suppose we're talking about a redeemable preference share. How will you compute the KP for redeemable preference shares? Again, two methods of doing it. The correct method is what? IRR. IRR method. Finite cash flows. Correct? You can frame the cash flow equation. Only difference is what? Every year, instead of I into 1 minus t, you will just be having preference dividend. Correct? No? Right? So initial inflow is equal to sum total of all the initial outflow. I just showed you the IRR computation. Take 2 trials, interpolation, arrive at the IRR. Correct, guys? Right? Or an alternative method is what? Formula, approximation, shortcut method. Now, you guys tell me what will be the formula for your preference dividend. KP formula, what will it be there? Exactly on the same line. Whatever we saw there, it is exactly the same. Whatever we saw for KD, it is exactly the same for KP also, with the only difference that instead of interest, you will be having what? Preference dividend. So what will be the formula here? Come on. Preference dividend plus same RV minus NP, but this is the cost for the entire life divided by life of it, N, the whole divided by RV plus NP by 2. As simple as that, and that's what they're saying here. Yeah, with this, very, very logical. Now here you don't have an alternative thing. Assuming this is tax deductible and all, that is not there here, because nothing is tax deductible. Here with this, guys. Here with this, guys. So here it is preference dividend plus RV minus NP by N, the whole divided by RV plus NP by 2. With that, KP itself is over. Right? And this is what I've given here in this particular area. In the absence of any specific information, use either YTM approach or approximation method. An approximation, it gives only approximate value. Net proceeds means issue price less flotation cost. If issue price is not given, then you go for current market price. If that is also not given, only then you should go for face value. As simple as that. And suppose flotation cost is not given, ignore it. Suppose flotation cost is given as 1% or 2% and they have stopped it there, either applied on whatever issue price you have considered or applied as a percentage of face value. Done. That's about this area. Clear with this, guys? Shall we go to the sums and do this? Right? Let's go and quickly do this. Guys, if you learn it conceptually, I'm telling you, you guys will thank yourself for a lifetime. That's all it is. Done and dusted. Right? So it's going to be question number 3. Yes. Quick. R Energy Limited is using preferred stock. Preferred stock means what? Preference shares. Okay, this is all some American English. They use this preferred stock and all that, right? At 100 rupees per share, with a stated dividend of rupees 12 and a flotation cost of 3%, what is going to be the cost of preference? Now, first, what is the life of preference shares here? Come on, guys. Don't jump into the calculation. First, read the question. What is the life of the preference? Not given. Then it is what? It is irredeemable. In that case, which one? First thing you need to do is read the question. Don't jump into the question first. Read it. Classify which category of instrument it is. Irredeemable, redeemable. This is irredeemable. In that case, simple formula, annual cash flow divided by discount rate is the present value. Or in other words, if you cross multiply, you'll get that annual cash flow divided by your net proceeds. Or in other words, what you pay by what you receive. Preference dividend divided by what? Our net proceeds. Or in other words, you can call it as P0. What is the preference dividend? 12 rupees. What is P0? They have said 3% flotation cost. Issue price is 100. 100 minus 3, 97. Answer is 12.37. And that's about this question. Go update your library of adjustment. That's all. Write down. Give all the cross-referencing. Question number 3, page number and all that. Write down. Cost of irredeemable preference shares hyphen direct. Sorry. Cost of irredeemable preference shares hyphen direct. Done. Shall we move on to the next question, guys? Quick. We don't have time to waste. Done. Let's move on to the next one. Take the next question, number 4. Preferential Limited issued 30,000 15% preference shares of rupees 100 each, redeemable at a premium of 10% after 20 years. Now, do we have a finite life here? Is it redeemable? Yes, right? Guys, first you collect the facts, then you can do the calculation. Read the question. See, even in, you guys follow cricket, right? Fine. In cricket, if you see, the way the success rate of a batsman's shot depends on the way he reads the ball. When it gets released, the way he releases it, whether the shining side is on the top or it is on the bottom, the way he releases it, depending on that, the batsman will know how the ball is going to swing or how the ball is going to spin, and accordingly he will decide on the shot. It should happen in a millisecond. But always, if you see batsmen, they focus more on actually how the ball gets released. That's why, there's a West Indies bowler called Sunil Narine. He will cover the ball so the batsman does not know, right? Or some people put it in the back. So that is applicable in real life. The way you approach your question depends on the way you read it. Spend time in reading. Don't take your calculator and immediately jump to it. Collect the facts. That's why I keep telling you this. So if you give me 6 hours to chop down a tree, I'll spend the first 4 sharpening the axe. Remember that. Don't jump to the execution. Most of the times you will not be successful in it. Spend time in reading it. The more time you spend on the question, lesser will be the time you spend in the solution. So don't jump to the solution right away. Read, collate the facts, and then you jump into it. It will just be a jiffy. Now we spent all this time, in learning the concept. In questions, how much time we are spending? Just like that, we are able to do it. It's a smart way of actually approaching anything in academics, right? Do that. Fine. So now they've said they've issued 30,000 shares, 15% the dividend rate, and the shares are each valued at 100 rupees, redeemable at a 10% premium after 20 years. The issue management expenses were how much? 30,000 rupees. And what do you mean by this? It's a flotation cost and it is given in total value. So which means in this sum, we will do the calculations for total, right? Fine. Find out the cost of preference share capital if they are issued at a par, premium and discount. Now, what is the formula for KP calculation? Come on, tell me guys. Once again, don't look at this. KP is equal to formula. Preference dividend plus RV minus NP by N, the whole by RV plus NP by 2. Right? Now, in this case, in all the 3 cases, redemption value is going to be 110. Correct? They have given it, redeemable at 10% premium. 3 scenarios is only for the issue price. Correct? This is why I said spend time here, not there. Most of the problem happens only if you don't read the question. Right? Don't jump to the solution. That's why I'm telling you. Please understand this. Okay. So now what happens here? Case 1, it is issued at par. Guys, what happens? Preference dividend 15 rupees into 30,000, 4,50,000. This will not change in any of the 3 methods. Correct? redemption value 110 into 30,000, 33 lakhs is going to be the total redemption value. Will this change? No. All the three cases, it is redeemed only at a premium. NP alone will change. Net proceeds, if I'm issuing at par, what will be the net proceeds? 100 rupees into 30,000 minus this 30,000 is nothing but what? This is going to be your flotation cost. Correct? No, it's an outflow. The net amount that I'm going to receive today is going to be 29,70,000. Guys, correct? You just need to apply the formulas here. So your dividend plus RV 33 lakhs minus NP 29.7 lakhs divided by the life 20 years, the whole divided by RV plus NP by 2. If you do this calculation, you will get 14.88%. As simple as that, right? So first, know the formula logically. You can write it here. Second, read the question properly and collate each of the ingredients of the formula. And third, substitute the formulas with this particular ingredients that you've calculated. How can you make a mistake? The problem is, if you jump to the solution directly without spending the time in your answer, entire thing goes for a toss. Trust me guys, 4 months is no joke. 4 months is no joke. And don't blame that CA course is a tough course. No, it's, 80 to 90% of things are here. We know that they are all avoidable mistakes, but still we do it. Simple. If you are doing it, try to avoid it in future. As simple as that. We all make mistakes. Let's learn from it. Clear with this? Fine. Now let's go to the other one. Suppose in case I'm issuing it at a premium of 10%, difference dividend will be the same. Redemption value will be the same. The only change is on the net proceeds. Instead of 100, it's going to be 110 into 30,000 minus this rupees 30,000. So as a whole, it's going to be how much? 32,70,000 rupees is going to be your net proceeds. Substitute here, preference dividend plus RV minus NP. NP becomes 32.7 lakhs by N, the whole by RV plus NP by 2. Clear with this, guys? You get how much? 13.744%. And similarly, if it's going to be at a discount of 10%, preference dividend redemption value, no change. Only the net proceeds you get a change. What is it? 19 to 30,000. Right? Minus the 30,000 of flotation cost, you get 26.7 lakhs. So it's 4 lakh 50 plus 33 minus 26.7 lakhs, the whole by 20, the whole by 33 plus 26.7 by 2. So you get a figure of 16.131%. Everything is same. The only difference here is with respect to calculating the net proceeds, because they have said here the issue is at par premium discount, right? Please mark that you've made a mistake, means mark it somewhere there. You've made a mistake here. Know that this should not be repeated. That's why I'm saying don't jump to the solution. Clear with this, guys? Any problem here? Any problem here? Very simple. Suppose in this question they have asked us to do this using IRR method. Then what you need to do IRR method, frame the cash flow equation, step number 1. Step number 2, what you need to do is you need to take 2 trials, right? Generally the tables for these 2 trials will be given in the question. With that, you take the 2 trials. Once you take those trials, you'll get 1 positive NPV, 1 negative NPV. Interpolation, you arrive at the final. Here with this, since in this question they have not given any specific instruction method to be used, you can follow any of the methods. Clear with this, guys? Done. Just go and update your library of adjustments. Write down. Previous question you noted down now. Write down cost of redeemable preference shares within bracket formula method hyphen par premium and discount. Par premium discount. Par stroke premium stroke discount. Done? Perfect. Okay. Fine. So with that, I am concluding this session because I want to start KE in the next session. KE is the most important aspect of the entire chapter. So I will start KE and on a fresh note in the next session. So on this note, I am concluding this session. Please revise till whatever we have covered till now, and I will see you all in the next one. Thank you all so much.